Welcome to Breaking News to Trading Moves.
Today we're looking at a specific corporate action. Netflix just approved a 10-for-1 forward stock split.
And our job today is really just to lay out who might gain from this and who might face some pressure based on the market analysis we've looked at.
Exactly. We're sticking to the analysis, pinpointing those potential immediate effects.
Okay, so let's get the details down first. Netflix, the ticker is NFLX, approved a 10-for-1 forward split.
Right. And the key dates here, if you're a shareholder of record on Monday, November 10th, 2025.
Okay, November 10th.
You get 9 extra shares for each one you hold. Then the stock starts trading at the new lower price a week later, Monday, November 17th.
November 17th, got it. So before we jump into winners and losers, let's talk about what a split actually is and maybe what it isn't.
That's crucial. Look, a stock split, even a big one like 10-for-1, it's really just an accounting change.
Yeah.
Meaning the total value of the company, its market cap, stays exactly the same. The pie isn't bigger, it's just sliced into more pieces. Your slice might look like 10 smaller pieces instead of one big one, but the total amount you own is the same.
So the actual business, its prospects, its value, none of that changes because of the split itself.
Correct. Intrinsically, nothing changes for Netflix, the company.
But, and there's always a but in markets, isn't there? These splits do seem to cause movement. They act as catalysts, you could say.
They absolutely do. It's more about market mechanics and psychology. When that per share price drops dramatically, say from $500 to $50.
Right, suddenly looks a lot cheaper.
Exactly. And that tends to do 3 things pretty quickly.
Okay, what are they?
First, you often see more retail traders jump in. That lower price point just feels more accessible, especially for smaller accounts.
Easier to buy a round lot or even just a few shares when it's $50 instead of $500.
Precisely. Second, options activity usually picks up. The contracts become cheaper on a per-contract basis, even though they control fewer shares post-split.
Okay, cheaper contracts. More trading there too.
Generally, yes, more volume. And third, the sheer number of shares outstanding increases tenfold, which boosts short-term liquidity, makes it easier to get in and out.
So retail interest, options activity, and liquidity, those are the mechanics driving the immediate reaction.
That's typically what happens.
You're
and
right.
that immediate flurry of activity is what can direct attention and capital towards certain related areas.
All right, let's follow that capital then. First category, our analysis flags as potential beneficiaries. Retail brokerages and trading venues.
Makes sense, right? If that lower share price pulls in more retail traders.
Then the platforms they use to trade see more action.
Exactly. Think about low-cost brokers. More trades, more single stock options activity. That means better engagement metrics for them, potentially more order flow.
And the analysis specifically calls out Robinhood markets, ticker HOOD.
Yep, a key gateway for that retail flow.
And also Cboe Global Markets, CBOE.
Right, Cboe being a major exchange, handling a lot of that equity and options volume. More transactions generally helps their business.
Okay, so that's the retail side. What's the second category?
Options market makers and platforms geared towards more active traders.
So moving beyond just the retail brokers, why do these guys benefit?
Well, it links back to that increase in options activity we mentioned. When the stock splits 10-for-1, the options contracts adjust.
How so?
An options contract still typically represents 100 shares. But after this split, those 100 shares are worth 1/10 of what they were before individually. So the price of the contract, the premium, drops significantly.
Ah, so even though the total underlying value is similar, the cost to actually buy one contract is much lower.
Much lower. So traders, both retail and professional, might trade them more actively, buy more contracts for the same amount of capital, or just find it easier to get into a position.
And more contract turnover
Means more opportunity for market makers who provide liquidity and spread the small difference between the buying and selling price, and also good for brokers who cater to those active options traders.
Which brings us to the specific names.
The analysis points to Virtu Financial, ticker VIRT, a major market maker,
Okay.
and Interactive Brokers, IBKR, known for serving more active professional traders. They benefit from that potential pickup in volume and, the related trading activity.
All right, moving away from the pure trading and market mechanics side, the third category links back to Netflix's actual business streaming, cloud and edge delivery providers.
Yeah, this one is a bit more of a secondary effect tied to attention and potential engagement.
How does a stock split drive cloud usage?
Well, the thinking is the split generates buzz, Lots of news, lots of discussion about Netflix that can sometimes, nudge people to think about the service itself.
So maybe sign up if they weren't already, or just watch more.
Potentially. If that renewed attention does translate into more streaming hours, more people watching movies, watching shows, then that means Netflix is pushing more data.
And pushing data requires infrastructure.
A lot of infrastructure, content delivery networks, CDNs, and the big cloud providers who handle that massive video delivery workload.
So if streaming hours tick up, even slightly, due to this renewed focus,
Then the companies providing that backbone see increased demand. The analysis highlights Akamai Technologies, ticker AKAM, a major CDN,
right?
and, of course, Amazon.com, AMZN, largely because of AWS, their cloud platform, which is, critical for supporting large-scale streaming globally.
Okay, so potential benefits for brokers, market makers, and even the underlying tech infrastructure. Now let's flip the coin. Markets often work like that. If someone's gaining attention or capital, someone else might be feeling the pinch.
That's the dynamic,
Yeah.
especially in a competitive space like media and streaming. The first group identified as facing potential headwinds are the direct-to-consumer streaming rivals.
So other streaming services, why would a Netflix split put pressure on them?
It's mainly about focus, investor focus, advertiser focus, and viewer focus. There's only so much attention, so much capital, so much screen time to go around.
So if Netflix is suddenly getting all this positive buzz from the split,
It might draw some of that focus away from competitors, especially any perceived as having less momentum at the moment. It could affect investor sentiment towards them or even influence ad budget allocations down the line.
and the analysis names.
Warner Bros., Discovery, ticker WBD, and Paramount Global, PARA. It becomes a relative game. If Netflix looks stronger or gets more attention, these competitors might seem less attractive in the short term.
Okay, that makes sense. What's the next category feeling pressure? CTV platform and aggregator competitors.
Right, this is about the connected TV space. Think about the platforms where people access streaming apps.
Like Roku, ticker ROKU. Why would they be under pressure? They host the Netflix app, don't they?
They do. But it's more about the competition for advertising, especially as Netflix builds out its own ad-supported tier.
The ad angle again.
Yeah. If this split and the resulting attention help Netflix significantly boost engagement on its ad tier,
They capture more eyeballs and more ad dollars within their own ecosystem.
exactly, they become a more dominant place for advertisers looking to reach streaming audiences. And that could put pressure on the ad inventory available on other platforms.
So it could potentially impact the rates Roku or others can charge for ads on their platform, or just make Netflix a tougher competitor for those ad budgets.
That's the potential pressure point. It affects the value of ad inventory across the board. The analysis mentions Roku, ROKU, and also Fubo TV, FUBO, as potentially feeling this competitive heat, especially on the ad side.
Got it.
Right.
One more category facing headwinds, legacy pay TV distributors, the cable companies.
Yeah, this is almost a classic reaction anytime a major streamer like Netflix gets positive news or buzz.
It reminds everyone about cord cutting.
Pretty much. It just tends to highlight that ongoing trend away from traditional cable and satellite bundles towards streaming.
So the split itself doesn't directly hurt them, but the conversation around it reinforces a negative trend for their core business.
That's the idea. It puts a spotlight back on subscriber losses, pressure on their video ARPU, average revenue per user. It just adds to the existing narrative challenges for them.
And the companies flagged here?
The big incumbents: Comcast, CMCSA, and Charter Communications, CHTR. Any positive Netflix story tends to be viewed, relatively speaking, as a negative for the traditional pay TV model.
Okay, so we've covered the mechanics, the potential gainers, brokers, market makers, infrastructure, and those feeling pressure rivals, CTV platforms, the cable guys. Let's distill this into what someone watching this should actually look for. What are the key things to monitor?
The absolute key is the follow-through, especially after November 17th when split-adjusted trading begins. Does that initial burst of volume, particularly retail and options volume, actually sustain itself?
Or does it just fizzle out after a week or two?
Exactly. Splits often create a short-term pop. But if there's no substance behind it, if the business fundamentals don't support continued enthusiasm, that momentum fades fast. So watch the volume numbers closely in late November and December.
Anything else?
Yeah, listen carefully during the next round of earnings calls, especially from Netflix's competitors.
Like WBD and Paramount.
Right. See if their management teams mention anything about the competitive environment, subscriber trends, or ad tier performance. Do they explicitly or implicitly point to a tougher market, perhaps influenced by renewed focus on Netflix? That commentary can be telling.
So track the trading volume durability and listen for competitive reactions in the following quarter.
Those are probably the two most practical things to watch to see if this split had more than just a fleeting impact.
It really highlights how something purely, well, mechanical, like a stock split, can redirect focus and money, at least temporarily, across a whole bunch of connected industries.
It does. From the trading floors to the cloud data centers. It shows how lowering that per-share price can really open the floodgates for trading activity, even if the company's value hasn't technically changed.
So a final thought for you, the listener. When you see events like this, look beyond just the stock that split. Watch how quickly capital moves into the expected beneficiaries and maybe out of those feeling the pressure. That speed can tell you a lot about market sentiment and how interconnected these sectors really are.
And before we wrap up, we have to make this clear. None of this discussion constitutes financial advice. We are not recommending you buy or sell any securities.
Absolutely. This is purely based on the author's opinion from the market analysis we reviewed. It's for informational purposes only.
Please do your own research or consult with a financial professional before making any investment decisions.
Thanks for tuning in to Breaking News to Trading Moves. We'll talk to you next time.